G'day, thanks for sticking around and showing up. I hope you've all got a drink. I've been instructed that my job here is to provide the happy ending to today's conference. So let's see how it goes. What I want to do is make this a real relaxed sort of question and answer with the people up here who are, they study the markets, mining companies and that, for a real job. And I think the first question I want to get to, and this is a relatively short answer, I hope, but I'm going to start with you, Gwen, a short answer. What does the world look like 6 months from now?
Summer.
And we can talk about, the metal markets, the major markets, gold, Corona, Trump, Bernie, etc.
I will leave U.S. politics to Americans. So obviously very hard to know. My crystal ball broke just the other day. But I'm pretty confident in saying that gold will be higher in 6 months than it is today. I think that it could still go lower between now and starting to rise again. But I believe the fundamentals of gold, primarily based in negative real rates and negative real rates are here to stay for some time. Fundamentals for gold are very strong. Yes, it's getting sold right now, but I don't think that there is a fundamental, long-lived economic issue right now that will cause this correction crash to be long, to be a sustained event. It may yet be somewhat deep, but I don't think it's going to take a long time. And the market has been trained, going back to 9/11 and then to the Great Financial Crisis, that the last few crises have been deep, but they've had strong rebounds, helped a lot by central bank maneuvers. I don't see any reason for that to be different this time. And gold does well out of those events because of the risk aura that's around them. But this time it's grounded in negative real rates. So I'm just going to stick with gold will be higher, and that means that there's going to be opportunities in the gold space, very nice buying opportunities in the gold space between now and then. I just don't know exactly when that moment is.
Great, thanks. John, you're stuck in the States, so you may have a bigger, broader picture as to what's going on down there. What do you see things looking like 6 months from now?
Well, I think the coronavirus is more damaging in terms of the response to it than it itself is likely to be. We've already seen that in China, and I think the market sell-off is in part reflecting the domino effect of the supply chain disruption that will take months to repair. But now we have the specter of the virus propagating in the United States and the fear that comes with it and disruptions of economic activity in the United States itself. So this is going to create a crisis window which is going to fix what I think has been a real problem. And that problem has been the absence of a story as to what will keep America great, or even better, make it greater. When they did that big corporate tax reform and all that money came back, it was supposed to go into rebuilding America, building a productive capacity. It didn't happen. It went into the market because the business community does not have a vision of where America is going. This coronavirus is going to create a crisis that will cause a significant correction in the equity markets, which is needed anyways. Mm-hmm. The response to it is the keeping of the one promise that Trump has pretty much ignored, and that is infrastructure renewal. And once they get onto the program of getting serious about rebuilding America's infrastructure, that will send a signal to the business community. It will send a signal to the world that America is growing bigger. It's not going to forfeit its leadership role, and it will get the American population perhaps out of its feuding funk that it's in right now and get out of this end times mentality. But of course, this will require fiscal stimulus, debt expansion, but with rates going to go down to near zero, what is the future interest rate cost of any debt raised to rebuild America? That, of course, will be good for gold, both because now that bonds are yielding the same amount as gold, better to own gold. And of course, for the other half of our junior sector, the raw materials, there'll be a vision as to why there's going to be a future demand for it. So I think in 6 months, we will probably be at the beginning of a major revival, not just for the resource sector, but also for the global economy.
Okay, so it looks good. Jay?
Later, you said 6 months.
6 months, okay. Yeah, I think the question is how deep does this go? I know I saw some numbers that are coming out. The Chinese PMI on Monday, it was the last reading for January was 50.1, and the announcement that's going to come out on Monday is 29.9 on the PMI. So now my friend Chen here thinks it's been factored into the markets, and I hope so. The question is longer term. I think it could be deep. We should get over it, hopefully. But the thing that I think is different this time possibly is that we are heading for negative interest rates. The world's reserve currency, borrowing and lending and negative rates, the treasuries are going to. Interestingly enough, though, the junk bond market last week went in the other direction. So it was really the risk debt is in trouble the way it looks. No, I think that how deep this goes and what happens to the world's reserve currency when we're in a negative interest rate regime. Alistair McLeod, who's been on my radio show, has talked about this in the past. Everything is priced in U.S. dollars, so all your commodities are priced in U.S. dollars. What happens when you can't get a positive yield anymore on treasuries? And everything has a time preference rate. Gold, copper, whatever, your house, you'll lend your assets away, but you want something more in return in the future. So why would you buy treasuries? And I think that what's going to happen is it will be probably only the Fed will be the only buyer of treasuries ultimately. Because who wants them? I mean, there will be some liquidity needs from pension funds and the like. Right now we're seeing money coming into the States from around the world. 94% of the investment grade debt has been in the United States. At least that was a few months ago. So when the rest of the world and the market forces force interest rates in the U.S. below zero, I'm not sure. I think these are uncharted waters, and hopefully Gwen and John are right, and 6 months from now we bottomed and we're better than ever. We have a tremendous opportunity. Gold isn't going to go down. Gold will stay exactly where it is now in terms of its purchasing power, but the dollar and the rest of the fiat currencies are going to go down because the Federal Reserve, the central banks know nothing more than to continue just printing, and I think exponentially. So it's going to be a very difficult time, I think, in the short term at least, but then from that can come great opportunities.
So summarizing, unless you own gold, we're screwed. Is that what I'm hearing?
No, I think actually that at some point in time, again, everything has a time preference rate. So copper, whatever you want to look at, I think if we go negative in the global economy, why would people want to buy dollars if they can buy copper and lend it out for a positive yield?
Okay. And finally, at the very end, a good friend of mine from Germany, Ralph Sommer, who is one of the savviest investors I know.
Thank you.
What's your opinion?
Well, I think one thing is for sure, that coronavirus is not going away within the next 6 months. So it will be with us for a long time. The question will be, what do the markets do with it? We saw the first heavy reaction last week, but I personally think we are right at the edge at the moment. Either it's going to continue and the general market's going to get hit again next week heavily. Then, we're going to go to a completely new level in the S&P, as an example, down to 2,600. If that doesn't happen, because we've had so many very heavy selling days, and especially last Friday, I was on the flight over to Toronto, landed, put on my phone again, and said, wait a second, Gold was hit by $60 down, but this was a typical, it looked like panic selling the first time to me. It looked like, there was big liquidation in the market. Some of the mining stocks, especially the junior mining stocks, you always, if you look at the bid and asks and over the last 2 months and the depth of the market, you have good offers and bids, between 10 and 20% down. And then you have that gap, right? And some shares traded like somebody was pressing a button, these 15% down, no problem, and then whoop, down 50%. And immediately bouncing back. So that the easy explanation to me is that was just liquidation. And, somebody was, or some people were executed, maybe a big fund, and there were no bids. So these very low bids were triggered, but you couldn't buy more shares at these kind of prices. So the next couple of days will show whether gold can hold around these levels and maybe test the 1500 level, but not lower. If that is the case, it will be a very, very good situation for the industry. And I agree with Gwen when she says that we're going to have a relatively good second half of the year. But as well, I think that the general markets will stop falling at one point here, and that is a buying opportunity no matter what. At least it gives all the central banks in the world the perfect excuse, that virus, to continue with their politics. And that is a perfect environment for gold. The question will be, can gold execute on that environment, or is there more pressure on it? We will see. We will find out.
So did you buy anything on Friday?
Yes, I did.
You want to give a couple names that you bought?
Yeah, I bought Max Silver at 11.5 Canadian dollars. The week before it was trading at 17. I always liked the stock. I bought some Sandstorm gold at $7.50, which was a ridiculous price as well, I think. And actually, that was it. And I stayed away from most of the juniors. I tried to put some bids in. I put the bids in, but I didn't get an execution on it. So, and that told me that this was more panic orders getting executed in the market. And we will all get the answer on Monday and Tuesday whether this continues or not. I don't think so. I think the market will bottom out here. But what do we really know? I mean, these markets were, especially the U.S. markets, were driven by algo traders and momentum traders, and that worked perfect on the upside. But what the most of the people forget that it works as well on the other direction, right? So we'll see.
Jay, what did you buy on Friday?
I bought some Irving Resources, actually Thursday,
Okay.
and it did very well. It actually rebounded on Friday, so that's the only thing I bought, and not much. Just a little bit nibble away. Didn't have that much cash, unfortunately. I'm unlike my good friend Chen, who seems to always have bucket loads of cash at the right time. But
John, what did you buy on Friday, if anything?
Oh, I didn't buy anything. But if I had spare cash sitting around, I would have bought one of my favorites, which is Verde Agritech, which got down to 33 cents. And that's one of those stocks that eventually has 100-bagger potential, and it's not very liquid. And this type of panic selling by somebody who needs liquidity, you can only get a cheap price for something like that. So that's what I would have bought. Some of my subscribers did buy that when we talked about it in our Slack space.
Gwen, what did you buy on Friday, if anything?
In the morning, I was on the plane for half the trading day on Friday, so not as much opportunity. But I have two portfolios. I have the one in my main letter, which is high-risk stuff, And I didn't buy anything in that arena because I feel like the risky things are still too volatile when you're talking about catching falling knives to worry about them just yet. But then I have the low risk portfolio that's for my monthly newsletter. And so in there I have such exciting stocks as Kinross, Western Copper and Gold, and Sandstorm. And I bought some of all of those because I think but not very much. I dip my toe in. I don't really feel a rush to buy things yet because I don't know what's going to happen on Monday.
Did you?
And I don't feel the need to time the bottom precisely. You just need to be close.
Fair enough. Just for anyone interested, I ended up buying Pan American Silver, Mag Silver, and Equinox, as well as always looking for dividends, and picked up IBM, Westrock, and something called Masabi Trust, all high-paying dividends that just got whacked. So I also felt it was hopefully a good time to buy. One of the best indicators I think for this junior sector for us newsletter writers is subscriptions. So how have your subscriptions been going, Gwen? Are they up, down, flat? What's it been looked like over the past couple of months?
In the past, I look at it usually at the end of the year. 2019 was definitely increasing subscriptions. I don't remember the numbers. It's also, it's part of what you do and it's part of the interest level. And by that I mean how much marketing you do. And so I put on, when gold started to have fun in the second half of the year, I started to try and encourage subscriptions. So it was rising in 2019, and then it sort of it definitely flatlined in November, and there were cancellations. So I feel like it hasn't been a distinctive, outstanding change. It's sort of been just tracking the gold movement as it has since the beginning of 2016 still.
John?
Late 2018 was a very good period because there was a lot of optimism that 2019 would be finally the turning point for the juniors. But 2019 was perhaps the worst year for the sector in general. And so subscriptions have been on a downturn, and even with the turnaround in January, everybody is now in cry wolf mode. They say, I'll believe it when I truly see it. So if you're looking for subscription rising as a contrarian indicator, time to sell, we are nowhere near that point. We're still in the ideal. If you're still in this space, there is still time to make very strategic purchases.
I personally think newsletter writers will have a very, very good time when gold holds here and turns around, because I see it in Europe, especially in Germany. The German market was always, the German people like the mining industry, always invested there. But there is no interest at all in retail. The reason is it was way too easy to make money on the US markets. They were falling over themselves buying Tesla and all this bullshit, right? But, they made money. And, how do we explain to somebody that they should buy a junior mining stock with all the risk, which is in that business, and listen to a newsletter, which is not a normal kind of publication in Europe, right?
I've got no idea why anyone would listen to a newsletter either.
Yeah, but you guys are. I mean, this industry is a small industry compared to others, and without newsletter writers, junior mining companies wouldn't have a single chance to tell their story accurately, right? And therefore, it's very important that you have independent newsletter writers. So I think if that happens, because we see now these bigger corrections, and when I talk to my old colleagues at Goldman, and they've in New York, I think things are changing a little bit. There are a couple of generalist funds who definitely look into this market segment again, especially because the other segments are so stretched, and compared to where we're trading on mining shares, if you look at the underlying commodity and if you compare it to the general markets, they are, they offer very, very, very good opportunities now. And if that changes, it helps as well the newsletter industry over here in North America, because these are the only people who can give some information to everybody, and therefore I think subscriptions will go up when gold holds here and goes to new all-time highs, hopefully in the next 2 years. Then you're going to have a lot of fun.
What have you seen, Jay?
I think we were up, maybe our numbers were up about 10% last year, and they were going well so far this year, but we'll see what happens after last week. I have an idea that, but in terms of, I think that it's true, there's no way you can lose in the stock market. The Powell pivot at the start of 2019 pretty much told everybody that don't worry, the Fed has your back if you buy stocks. And now we're hearing some of the Federal Reserve, was it Janet Yellen or somebody anyway recently was suggesting that the Fed should actually come in and start buying the stock market if it crashes. So, let's say that this industry in many ways has, has the establishment against it, against gold for sure. I have no question about that, because gold competes with the dollar. And if the gold price starts to go crazy, it means they've got to get that under control, because they don't want people thinking gold is better than the money that's created out of thin air. So, I think that that things turn around here, then I think it will be very good for our industry, for the newsletter writers.
I hope so. Joe and I, we've seen, we don't get much churn. Our newsletter subscribers tend to stick with us and not leave. And our marketing is rather stealth, so we don't bring a lot of new ones in. But it's surprising to me that it hasn't picked up as much as I would have expected, which tells me kind of what we're hearing here is that it's still a lot of people out there who really aren't aware of this sector or don't know how to get into it. And I think that's a positive. The
sector was just ignored. Yeah. Because it was too easy to make money otherwise.
Yeah. And the public doesn't understand the negative correlation of gold with the general market, but they're about to learn perhaps.
And what junior mining companies shouldn't forget, when we had this last heavy bull market from around 2006 to 10, there were no ETFs. There were no derivative products on it. The only chance to buy leverage was going and buy mining shares. This is different now. And if you look at the performance of these derivative products compared to junior mining stocks, they do better. So and you don't have,
both upside and down. I think we're going to see a downside.
Of course,
right now, right?
Of course, but at least they're following the underlying product, which, suddenly, and most of the mining companies don't do.
So Brent, do you think there's any substance to the rumor that the $60 drop in gold on Friday was caused by gold bugs who missed the general equity bull market so that they would have some money to buy the dip in the general equities?
I really don't know about any of that. I'm not just a geologist.
Because what I'm thinking is the problem is that the gold bugs have abandoned the junior sector, right? They're not, the question is, gold has done really well in the past year, and all the reasons are there for it to go through $2,000 and beyond, and not just because of fiat currency debasement and hyperinflation, none of which are in the cards right now. Why is there not money coming into this space from the traditional gold bug audience for this sector?
But it's such a small. Yeah, that's exactly right. This is it. Yeah, it's such a small universe.
And the coronavirus is in this room. This is your Prince Prospero, right?
It was just too easy to make money otherwise.
6 months ago. Okay, so the PDAC gets started over there tomorrow. The downstairs main hall, you're all going to be walking around looking at the booths, trying to decide what's good, what's bad, etc. I want to throw a question out to you. Is as you're walking around down there, looking at all these different booths and the people standing in front of them, what is something that you see most often that makes you turn away and walk on past? Gwen, we'll start with you.
So many to choose from. The two that I'll pick on are projects that you've seen many times before presented differently. So, you remember them from the last cycle. Maybe it's packaged differently with a different gold price or something. And I shouldn't knock that broadly. There are absolutely projects out there where a new geologic interpretation can turn around an asset that was boring and turn it into something valuable. But most of the time, rehashed assets are not worth spending time on. So I'd say the easiest differentiator there is who's doing it. And you have to have a lot of confidence in a team if they're taking on an asset that's been worked several times before. You have to have a lot of confidence in what they're doing, why they're doing it, and that they will be successful doing it. You always have to have that in teams, but I think that's perhaps even more important than usual with rehashed assets. And then share count is probably the other one. I like it to be fairly small.
Okay, John.
There's 300, 400 companies there, and just looking at the booth, there's really nothing you can learn by just looking at it. What I'm interested in is something that I don't already know about. But I'm going to sit there and check out all 400. Well, there's not enough time for that. So how do I pick and choose? Well, I can't. For me, it's really a serendipity exercise, walking around, bumping into people, having somebody grab my sleeve and say, John, we have something new and different. And this happened today with Hannon Metals. David Henstridge, grabbed me and said, you got to take a look at what we've got. I said, oh, no, not that zinc stuff. and instead, it's a fascinating sediment-hosted copper-type story in eastern Peru generated by a new data set that was only released a few years ago. So this random type of encounter is what pulls me in. And if you're going to grab my sleeve, you have to very quickly tell me why you're not wasting my time if you're a company promoter. I need to get that sense that you have something new and interesting that almost nobody knows about.
Yes, good. Jay, what turns you away?
Well, I would say in my old age, seeing beautiful women at a booth. That's in my old age.
Is that a positive or a negative?
Well, now it's a negative. It used to be something else. So, no, I think the serendipity thing is right. John is right about that. But I think that one of the things that I look for now, also in my old age, and I learned the hard way, is the idea that scale. You need scale to make it worth your time. John is talking about, is it worth your time? And just small projects just don't make money. If they're lucky, if they meet the SG&A when they get into production, if they ever do. So that, and then I like to look for novel ideas, people that come up with novel ideas. John just mentioned Hannon, which I learned about recently as well. I like to follow Quentin Henning around what he's doing because he always comes up with things that other people seem not to see. And I just think he's one of very unique talent that's able to spot things that and he also, it's a bigger go home for Quentin. So, the Lion One that he's working with, Hannon, he's very familiar with, of course, Novo, Irving, these are some of the stories. But again, because seeing something that other people don't see, and of course, having the confidence in the people that run and if you're seeing, as an old guy like me, I see a lot of young whippersnappers that are just now getting into the business, and so you wonder, some of these guys are going to be good, but which ones? And you don't have a track record yet to run on. So, and it's a gut feel too in terms of the authenticity of the people, whether they're really. I think that's the thing about coming to these shows when you can meet people face to face. There's an element to it that, and actually, when my wife is with me, that's really helpful because somehow she has a sense of who a scumbag is and who isn't. So I can't figure that out. But women seem to have that capability, I've noticed over the years. And my wife is really good with that. So
True
I need,
confessions.
I need to bring my seeing eye dog with me, and she's not here.
You had to say
You're
that.
not supposed
So
to say
you're going
that.
to be migrating towards the booth with the good-looking girls now without the wife. Ralph, what strikes you?
It's I'm coming to PDAC since 20 years, and it's the same old, same old. I think what mining companies should definitely do, and they should do it very quickly if they want to attract new and fresh investor blood, is to change their way of presentation. They should present in a different way. If I walk the floor, I'm not a geo, so I come from the financing side of the business. These geos can tell me everything, still after 15 years, a lot of soft colors, it looks good, look at this, oh my God, and yeah, we drill here, the other were idiots, they drill just 50 meters away, right? So this doesn't help me, but a different way of presenting, why do I have this project, what do I want to do with it, and to put it more in a 3D version, a little bit more visible. I saw the presentation of Whistler, for example, this afternoon, and they were playing around a little bit with 3D models, which was good actually, because they turned it around, you could see it. That would make it way easier for new investors, new money, which everybody wants, right? To come into this market to understand what they're doing, because they have to make the decision, do I buy an ETF or do I buy something of this here, which I don't understand, where the guy is nice, but he can tell me everything, and then I have to go to a geo friend like Brent and say, listen, can you help me here about the geo side? And if he says, yeah, that's okay, then it's okay for me, but without that, okay, I wouldn't buy the company.
Well,
So-
that's a good point.
Yeah, I'd like to pipe.
It's still the same like 20 years ago. These funny little booths down there, I mean, the way of presentation has to change. That's a wish I have, right? It has to be made easier for investors. The mining industry competes with the young blood who is buying cryptocurrencies and other stuff, and who comes from a completely different education than most of us had, technical-wise. And they don't like this. They want to understand it. They want a different way of presentation. So that's what I would like to see down there. That doesn't mean that it's bad, but if you want to do something different, we expect the big mining companies to change their behavior of, why they take companies over and the way they value their own assets and all that kind of stuff. So I think that's the same for everybody here.
So
They should
so
change.
Gwen and Ralph have sort of talked about the recycled stories that we see all the time. And when I encounter them, I want to know, what was the previous group's understanding of what was this all about? And obviously the fact that you have it amounted to nothing. What are you bringing to the table in terms of something new and different, which is an argument as to why you may be successful? And that's actually hard to do. The really good geos have an explanation as to what they are seeing differently about what the others did. And so don't just dismiss the recycled stories out of hand. And even if it's the same group, that's a very quick question. Are you insane and doing the same thing over and over again?
They
Or
have to get their
is there
salaries, that's
something
why.
that you've come up with that's different? And, tell me that story.
That's a good point. I think one thing that, anyone, a geologist, whoever is in the booth talking to you, they should understand their property well enough that they can explain in basic terms what the concept is, what the target is, what the prize is in terms of actual economic value. And, when Joe and I go to a project, grassroots project, wherever, the first, you look at the rock, and right then and there, you've got to put together a mine, mentally, a model of the mine, the infrastructure, the capex, the metallurgy. All these things have to enter into it. And I find way too often that most of these companies are just on a treasure hunt, like let's go drill here. This looks good. And in terms of the recycle projects, that is usually, I would agree, is a turnoff to me. I mean, when I walk down there, those booths, and it's like, great, there's another guy in Ontario with a drill hole under an old pit that's got 7 grams of gold in it. There's no way I can effectively evaluate that without a lot more data and knowing the project and that, and everybody's got one. So I think Jay mentioned this, it's size that counts. There's no point, in my opinion, looking for a small deposit because it's not worth much and certainly not worth the risk. And a small mine comes with all the headaches and hurdles as a big mine, but you don't have the size to cover your mistakes. So that's kind of how I think about it as well. I also look at, I think it's important to say what is your economic hurdle? What do you need to find economically to make this work? And so I'm going to throw that question to you all, like Gwen. What sort of economic hurdles or criteria, I guess, do you use when you're talking to these junior companies out there just looking for something? Using IRR, NPV, what do you use?
I don't think I'd look as far down the line because generally I'm looking at like pre-discovery or early stage discovery exploration. I need it to generally make sense in a mining capacity, but really what I want is tell me what are you going to do in the next 6 months to a year that is going to, if it works, add value to the company and therefore grow the share price. So like, you talk about how there's too many companies out there that are just drilling holes and doing science experiments on rocks. And I agree with that. And I think those rocks may well have some value in them, but the only way that the investor is going to get exposed to that value or that value is going to increase is if there's a management team that understands how the market understands projects, understands resources, understands grade, location, so can tell the story, knows which way to chase the story to make it better in the current market and overall, but specific to the current market. So, a few years ago, all anybody cared about was grade. So you needed to make sure that your projects were probably higher grade and had capacity, and you knew how to chase that to some extent. It's not just about catering choosing a project that fits the market. It's about having a concrete plan to create value and knowing what you're going to do if step A doesn't work. Well, what's the next step? Is it a different project? Is it a different approach to the project? Is it more targeting work? It's about understanding that the point of this is a higher share price. And so you need to have steps to get towards that higher share price, not just ideas about geology. Because those are ideas about geology feed into the steps towards higher valuation, but they don't do it on their own, not by any means.
All right, let's make a pretend scenario here. Let's say some company comes to you with a porphyry copper target in southern BC, never been drilled.
Yeah.
There's some surface work. It looks interesting. There's an IP anomaly, whatever. Ballpark, what's going to work there? What do you need to see in the first set of drill holes to tell you this is working or it's not working? I'm talking grade.
Oh, grade. Oh, I was like, wow, you hit into grade on your first hole. Good for you. I thought we were just going to be talking about alteration. What you want in a porphyry in BC these days is like 0.5 is a great starting point. 0.5% copper, 0.5 grams gold is a great starting point. Obviously, you need that over a significant scale. So 100 meters at the minimum, but hundreds is better. But it very much in the first set of holes depends on the alteration, where you're located relative to your targets, your anomalies, and therefore the alteration is giving you an indication of where those grades may or may not improve, whether you're in the heart of it, things like that. So it's all about context, but you want to have confidence that you can have 0.5 or better if it's an open pitable scenario, and of course much higher than that if it's going to be an underground, but then we're getting pretty complicated for first drill holes.
John, do you have any kind of criteria you use for anything?
Yeah,
like that?
the first thing I would ask, how big is the blob that you think is there? In other words, tonnage, 100 million, 500 million, billion tons. So I get the answer for that. Then I say, okay, in that part of the world, for a, say, 20-year, 30-year mine life, what sort of capacity would that be? And that's simple. You just divide it by 20 years. Say it's 1 billion tons. That's 50,000, or whatever. I can't do the math in my head. But you find out what is the size of the CapEx going to be, and what is the OpEx. And then you have your simplified discounted cash flow model where you put in the costs and the CapEx, and then you play with the grade. And of course, you put in the copper price and whatever moly price you're going to get. And you run this thing at different grades to see if you can get an NPV at something higher than 5% discount rate that comes at close to or exceeds the CapEx, and hopefully an IRR that is 15% or higher. And so that's how you figure out what your grade should be for this. Now, if your grade comes in at like 1% and it's BC, and I say, can you point me in the direction of an open pitable deposit like that? So I want the companies to have done the economic geology for me and to help me understand the cost structure that's suitable for the size of the prize that they think that they can find. And then I can come up with a sort of grade idea, and then I know what to expect in the drill holes. And I can have my little model and plug in what they're getting, saying, wow, they're actually delivering this. No, it's 0.1%. This is a dead end. They need to find something better. That's the way I approach it. And the companies aren't allowed to tell us this, their back of the napkin calculations until they spend $10 million in 3 or 4 years delivering a PEA. But they are allowed to share what the costs are for different size scenarios of targets. And part of what my goal is to teach people how to also do this on their own and provide online tools to do this so that everybody can handicap the size of the prize and what you need. And then the key is, how much would the stock go up if they actually delivered that sort of outcome? You need to understand, if you're actually right, how much money am I going to make? If I'm going to make 20% on a drill hole, on a target, well, that's not very interesting. And that's the sort of logic you should use when you sit down with these people. And if the company can't answer these questions for you to write down and go home and play with, then they don't know what they're doing.
Exactly. Big red flag. Jay?
Yeah, I think the metrics that Gwen and John mentioned they sound right to me. I would just, looking at a porphyry situation, I would want to know, does it have the scale that will attract a major miner, the big boys. So that's what I would look at.
Ralph, do you have any comments on that?
I would ask you what you think about it, because
Well, he already sort of
That
answered
might
that.
cost you a beer or two.
it's difficult for me to make that comment just because I have no geo background and it's
Okay. So how much value? I mean, a lot of companies are, they get up here and they present and say, this project has had $60 million spent on it, and now we've got it, and we had $100 million spent on it, and now we've got it, and we're going to do this. Or we've got ounces in the ground that are selling for, I don't know, $10 an ounce per market cap. Do you put any value, or how much value do you put in that sort of a proposition that this is valuable? Ralph?
It depends on how that 60 or 100 million dollars how they spend that money, right? Is there a complete infrastructure on that project with mill and other stuff? That's a different story than just unsuccessful, in brackets, drilling. So it's very, you can't just say, okay, because it was drilled out and $100 million were spent there, then suddenly things become easier, right? Than having a new, fresh property, nobody touched it before. It definitely, I mean, for a geologist and looking at a property which had $60 million worth of drilling, it should give them a lot of answers to their questions. If they look at the at the drill results and how was it drilled, what was,
Okay. Anyone else want to comment on that?
I would just say on the ounce in the ground stuff, it depends completely on the stage of the project. So I think the more advanced you get, once you're past a PEA, and so there's some concept that you're in a potentially economic scenario, then I think those ounces start to be, those the dollars per ounce in the ground valuations start to become a little bit more pertinent. And I think they're perhaps useful for stories that are like new or under-recognized for whatever reason, like Revival Gold having just acquired this asset in Idaho, and people didn't really know who Revival Gold is, and so the valuation there when they came out with their 3 million ounces jumped because people were unaware. And so, but that understanding that a more advanced asset, you can put that sort of metric against it, helps investors make a move when the assets are a bit more advanced. So it depends on the stage, really.
And there might be a missing piece in that puzzle, right? So suddenly, one piece of property comes to the overall, former property and fills that puzzle, and suddenly it becomes a completely different story.
My
Right?
experience has been that maybe if you're lucky, 1 out of 10 projects that have had 5 people go bust on it, the 6th person's going to go bust as well.
Yeah.
I would think that an ounce in the ground by itself I don't think I know, it carries no economic information. So, 5 million ounces of ground doesn't mean anything. How the market's pricing it becomes interesting, because the lower the price, then I raised the question, okay, what is the underlying economics? So that's a flag for me to run the discounted cash flow model and see what metal price is needed to put this into the development threshold. But by itself, if you're just looking at these metrics and assuming the market's efficient, it's not a basis to buy a stock because it's only $10 an ounce versus
Again, my
$50 an
experience has
ounce.
been the same, is that, a dog stays a dog no matter what the price is, because there's a fundamental flaw. So anyway, I think we've got to finish this up. Thank you all for coming. I appreciate it. Hope it was useful, and enjoy the rest of the show.